Instead about thinking about your company and the branding of your own business, you're thinking about the experience that a customer has and how to maximize that experience. And then you build the branding around that experience, right? You're selling outcomes now. You're not selling products anymore. From a financial perspective, this introduces an entirely new set of metrics that you would run your company by. And that's what the core of this webinar is supposed to be, right? We're supposed to be talking about how do you inject this kind of thought process into every function within your organization. And from a CFO's perspective, which my belief is the CFO really has the kind of the catbird seat, so to speak, so that they can view all the other functions, but their responsibility actually gets bigger because their responsibility as a CFO or that finance function or whatever function is with the company, it could be a COO as well, is to inject all the other functions with the information that they need to optimize their business. Okay? So this shift, as I just mentioned, requires a cross-functional change throughout the entire organization. I'm going to quickly go through some different functions and some leads and what this might mean. And then what we're going to talk about is essentially how do you take those changes for those functions, and then how do you think about, okay, what are the subtleties that needs to happen within those functions about how they think about their business, and then what are the metrics that you might want to think about running your business by if you enter into the subscription economy. So what does this mean for the boss, right? What does this mean for the CEO, the GM, whoever is in charge of running that business, whoever is going to be held accountable for success in a subscription economy business? Well, first of all, you got to break down your silos, right? You've got to build this subscription culture. When you think about a traditional business today, you think about these functions. You think about sales. You think about marketing. You think about product. You think about engineering. You think about finance and IT. And they build a product, and that product then gets shipped to the customer. In the new world, you need to think about how every single one of those functions influences the experience that that customer might have. If you step back for a second, you think about what does a relationship-based business mean? It means there's a cycle to it, right? There's never really a beginning and an end. It's just an ongoing relationship. But as there's transaction sets throughout that relationship, as a customer might buy and upgrade something, right? Or as they might implement a new product of yours, or as they might call in for support after they have that product, right? This cycle continues to evolve and it continues to repeat. But in that cycle, every single one of these functions has a role. And the role that that function plays can determine whether that cycle is going to repeat or not. The whole goal of a subscription economy business is to have a lifetime relationship with your customers. And again, through that relationship, you will earn the right to monetize that customer. In doing so, you need to make sure that every single function, first of all, has an upstream and downstream view of what the ramifications of their role are as it relates to that relationship with that customer. They need to know what's coming down the pipe. If I am in a support organization, I need to know that, hey, sales has just sold something. Global services or your professional services just implemented something for a customer, and that customer is now going to start calling me. But I also need to know that, hey, once I start servicing that customer and they come in with tickets, again, I'm talking about the support organization, those tickets need to be, related somehow to our product organization and our engineering organization, because these tickets are information that you have from your customer that if they are not addressed, could influence the future cycles of that relationship. That's the whole different paradigm that a CEO or a GM needs to think about. He needs to think about putting a structure in place where that every single function does not work in a silo, but they work as if they are connected to all the other functions, and that the influence that they have in their function can determine the future business model ramifications on how that relationship with that customer operates. What about the VP of product if we move down the chain? That function, the product organization, now needs to shift from thinking about how do I build the next great product to how do I continuously innovate and continue to earn the right to have a relationship with the customers that I already have, right? In doing so, they need to know who those customers are. They need to know how they use the product. They need to know what they like and what they do not like about them. And then they need to constantly be innovating to be able to deliver the experiences that your customer expects. By the way, technology is shifting so rapidly in every single vertical that as a company, if you are not continuously innovating and delivering new innovation to your customer base, your competitor, who probably looks exactly like you, will do it. And if your competitor is doing it, the switching costs for your customer, right, may not be that great. And they will just hop over to the new competitor. If you don't constantly iterate, constantly learn, and constantly challenge yourself as a business to earn the right to have a relationship with your customer, right, they will switch. What about the person who's in charge of monetizing that customer? What about your sales organization, your growth organization, whatever you want to call them? They need to stop thinking about, hey, I need to hit my quota today and maximize for my current period revenue. They need to think about, how do I set up a relationship that I'm going to be able to monetize over time? And through that time, the net retention or the value that I experience is going to increase with that customer. In doing so, right, they're going away from selling more units and they're thinking about, how do I bring on more customers? How do I bring on more subscribers? They're going away from thinking about lowering our per unit cost, and they're saying, how do I keep those customers and subscribers? How do I lock them in? How do I make sure that they have a perception of value? And in turn, I get to experience a monetization. Instead of increasing prices, thinking about, okay, how can I actually jam a product through the channel with a 10% more margin on it? They need to start thinking about, how do I actually start thinking about increasing the value per customer? And again, if you go back to what the product organization is thinking about, it's thinking about continuous innovation and continuous learning about your customer. The only way you're going to increase the value per customer is if the product organization is doing their job and increasing the innovation, so the value perception that your customer has keeps increasing, and therefore you're able to gain more revenue from them. In doing so, we've isolated down to 8 strategies for growth. There might be more than 8 strategies. In fact, I'm sure there's more than 8 strategies. I know there's not less than 8 strategies, right? But these are the ones that pop up among our customer base over and over and over again. I'm not going to go through all of them, right? But when you think about it, it's some of them are simple. Launch a new pricing model, right? It seems simple. Execution can be very, very difficult on this if you don't communicate it right, if you don't research it the right way, if you don't actually push it through your own company the right way. Grow your sales team. This is dangerous, right? If you think that you have a huge market in front of you and you say, oh, all we need to do is go attack it, and you start hiring salespeople, how do you measure their efficiency? How do you make sure you're not getting too far in front of your skis? How do you make sure that you've set the quotas the right way, that you've thought about pipeline coverage the right way, right? That you've thought about how to make sure your salespeople are making money, yet you are experiencing, or you are executing with a customer in the right way so that you're building long-term relationships. These are difficult things to execute against. These are just some strategies for growth. What about the CIO organization? Traditionally, the CIO organization has owned the big systems internally that allow you to go execute. Whether it's your traditional ERP system that, is what you would be pushing a new product through, or whether it's your homegrown system that allows you to go price and package and introduce something out to the market. What does the CIO organization now need to think about? They need to think about, how do I allow my organization to be agile? How do I allow the company to go innovate quickly by allowing flexibility on pricing and packaging and new products or new market entrants, right? And how do I, move our legacy, old, disparate, rigid system infrastructure to something that's going to actually expedite growth as opposed to impede growth? This is a challenge. Yeah. Every CIO organization the first gut reaction is, let me build it. We can build it, we can do whatever you want, and eventually you end up with a whole bunch of custom code that ends up being a tax on your business. It's an anchor. It pulls you down, and it doesn't allow you to move. And then finally, what is near and dear to my heart is the CFO's role, right? And that's where we're going to spend the majority of time on our webinar today. In my opinion, and it's not just because I am a CFO, and I like to say we have the hardest jobs, But the CFO's job just got harder. When you think about a subscription-based business, you say, hey, okay, we have a traditional product-based business, we have a traditional one-time sell business, and we're thinking about getting to a subscription-based business. It's not just because you make this leap and you decide one day, hey, we should go do this, it'll be fun. It's because you see that it's happening all around you. You see that your competitors are starting to offer their products and services this way. You see a demand from the customer base that says, hey, we want flexibility in the way we consume your product and services. At the same time, you have technological innovation within your own company. Maybe you're inserting, sensors into products that you traditionally have sold and really have let go of at that point. But now through these sensors, you're gathering information. And with that information, you're able to innovate faster and you're able to learn a little bit about your customer and you're able to learn about how they're using your products. Mm-hmm. You say, wow, there's a lot of data now. Maybe we can actually start monetizing that data. Naturally, that monetization is going to be in some form of subscription. And when we talk about subscription, we're not talking about $10 per month for $120 per year. We are talking about a relationship with a customer, right? A subscriber that could be anything from freemium all the way through to annual fee or per usage fee or a hybrid of a monthly and per usage. It does not matter. Subscription, only thing that matters is that you have an ongoing relationship with that customer, a constant touch point, and through that relationship, you will figure out how to create a business model that works. In doing that, the CFO's job is the one who has to think about that business model and constantly be pulling the levers through all the other functions to be able to create the business model, but actually create the outcomes through the functional behavior that's going to optimize it. That problem, right, is that the customers demand a subscription-based business model. And if you don't shift, your competitors will win. At the same time, your investors are demanding predictability and efficiency, right? You have to run a disciplined business. You have to produce cash, right? You got to have income, right? But you also need to invest. So I would say there's three things to do. First, know your business model. For us, it's very simple. And I advocate simplicity all the time. We run our business on ARR. ARR is annual recurring revenue. If you look at any subscription business out there, they run on some concept of recurring revenue. And this is different from IFRS income or GAAP income, right? Recurring revenue is what you have in the bank. I have a set of customers who are contracted to pay me something on an annual basis. That's recurring revenue. And it's a very simple formula. Entering ARR minus churn plus new ACV, and ACV is annual contract value. That's essentially bookings, right, on an annual basis. Plus or minus FX equals X in the ARR. That is the foundation to any subscription-based business model. We then break the model into three pieces. We think about recurring expense, we think about growth expense, and then we think about one-time expense. Now, recurring expense is the foundation of any subscription business model. Recurring expense, if you just break it down and you think logically about it, it's what does it cost me to service my existing install base? Mm-hmm. I have this book of business, which is the ARR, annual recurring revenue, and I have a set of customers, let's call them 10 customers, who make up the ARR. Each one of these customers pays me $1 million a year. That's $10 million. Right? What does it cost me to keep those customers happy, to keep it running, and keep the company running to keep those companies happy? Therefore, for us, that is COGS, G&A, and R&D. And you can argue some R&D is for future customer acquisition and you're building products in the future. I say you're right, but we simplify everything. But because you're challenged on constant innovation, and if you don't actually continue to innovate, you will lose one of those 10 customers or maybe 5 of them. We say the R&D that you develop today will be pushed through to those customers, and that's what keeps them. Your new customers are actually buying what you have. They're not buying futures. And if they are, you're doing something wrong, right? And so it really is what you've already built that your new customers are buying. But to keep those new customers, you need to constantly innovate. And that's why R&D is in recurring expense. Now, the leverage in any subscription business model is the delta between your ARR, your annual recurring revenue, and your recurring expense. That delta we call recurring profit margin. And if you can grow your ARR faster than you grow your recurring expense, you have recurring profit margin expansion. That expansion or that recurring profit margin is your leverage in any subscription business model. Theoretically, if you have no market and you have no churn, you would fire all of your salespeople, right? You'd fire everything that makes up your growth expense, and you could bring that recurring profit margin to the bottom line every single year. And that is your free cash flow, and you create a terminal value off of that, and that's what you would be valued off of. That is the thought. Now, the difference between a GAAP or IFRS system or income statement and what we're talking about here is that ARR is like a balance sheet item. At any point in time, you can say, hey, what is my ARR today? What's my annual recurring revenue today? In the example I gave, it's $10 million today. We then think about, okay, if I have $10 million going forward, I will design my expense always in the rears. So I'll never get ahead of my revenue. In the traditional old modeling of financial planning, you go into a year saying, well, I think I'm going to do this much revenue because I'm going to do this much sales. And then I go ask everybody what they need to spend next year. And you have these annual operating plan processes where you ask engineering what they need, you ask G&A what they need, and everybody comes in and says, well, we need 20 headcount. And everything rolls up, and inevitably you're at 200% of what you can afford, and the CFO cuts everybody back, and they go back and say, okay, instead of 200 or 20 headcount, you get 10 headcount. Mm-hmm. In a subscription model, you're always behind it. Instead of saying how much head do you need, you say, our goal this year is to have 40% recurring profit margin. That means we can only spend 60% of the entering ARR in COGS, G&A, and R&D. When you structure the conversation that way, you will never be over budget. The only way you would be over budget is if your churn, right, dramatically exceeded what you expect. But because you're budgeting ahead of the curve every single time and off of entering ARR, you can always adjust. So that's recurring profit margin. Growth expense is what you spend to grow. It's very simple. For us, it's sales, marketing, and customer success. You determine how much you spend to grow based on the efficiency of that spend. We call that efficiency our growth efficiency index. I'll show you a few metrics in a second that, there's a CAC ratio, there's a magic number, there's all kinds of different calculations. CAC is customer acquisition cost that you can go through. And I'll show you them in a second. Just pick one and measure it the same every single period. Simplify, simplify, simplify. But if you measure consistently, period over period over period, everything will normalize. And then you will have a data set of at least your own benchmarks to compare yourself against. And then the third thing, which is not on this slide, is one-time expense. And the one-time expense is something that does not recur. It could be the cost of building a physical product. For us, it's professional services. We run it as a separate business. Our product, when we sell our software, there has to be an implementation. That implementation costs money. But we run it as a separate business. We run professional services break even. As a CFO, if I think there's a finite amount to any deal, I would rather take dollars and push them into recurring revenue stream as opposed to put them into a one-time professional services stream. So our mandate for services is twofold. One, bring customers live successfully on our platform. Two, try to do it in a break-even fashion. As long as it's break-even, it's predictable. And that one-time expense, whatever you have, it just needs to be predictable. You could choose to lose money in that one-time expense as a loss leader to build your customer base. It just has to be predictable. That is our fundamental business model. Growth spend, incur to maximize ACV, traditionally sales and marketing efforts, sometimes customer success. Recurring spend or recurring expense, incurred to support existing install base, traditionally COGS, G&A, and R&D, what I just described. When you look at this and you think about your recurring profit margin, which is the amount of funds that you have to use, you could say, and then remember, recurring profit margin is the delta between your entering ARR, or annual recurring revenue, and your recurring expense. Mm-hmm. You could say, hey, I want to spend all of my recurring profit margin on growth. And in doing so, you would grow and you would break even. right? Because you spent your entire ARR. You could say, I want to spend less of my recurring profit margin on growth, and I want to bring some dollars to the bottom line, and I'll have some profit. Mm-hmm. Or you could say, I want to spend more than my recurring profit margin on growth, and I would choose to lose money. Mm-hmm. How do you make that decision? How does a CFO work with the growth organization to say, you know what? Yeah, we're going to lose money purposely. That decision is based, again, on the efficiency of that spend. The market is rewarding growth, but it's not just, you wouldn't do it just because the market's rewarding it. You would do it because it makes sense for your business model. If you understand the value of acquiring, what that customer means to you, and to acquire that customer, you know that you're going to get a revenue stream for a certain period of time. Think about LTV or lifetime value. Mm-hmm. It might make sense to spend a lot to acquire those customers, assuming that you're going to keep them. In that case, your inhibitor becomes cash. It's how much cash do you have that you can spend to grow? But you need to understand what the metrics are to be able to dictate the behavior and what you allow as the business in terms of the expansion. And if you don't know the efficiency of that spend and you cannot measure it, then it's a very dangerous place to be, because quickly you could go try to acquire as many customers as possible. You might get a lot less efficient at it. And in doing so, you could burn a lot of money and lose a lot of money and actually have a business model that does not work. Again, this is just another metric that you need to be able to measure.
Right.
So in this world, to give a simple example, if you had a GEI of 1, a GEI again is a growth efficiency index. It's just our take on the efficiency of growth spend. And the way you think about it is, if I spend $1 in growth, what do I get in annual contract value, which again is the increment to ARR? What do I get back? So if I spend $1 and I get $1 back, that's a GEI of 1.0. If I spend $2 and I get $1 back, that's a GEI of 2. So the lower the GEI, the better. So if you have a GEI of 1 and churn at 15%, you'll have 35% growth while maintaining break even, if that makes sense. And we can walk through that business model right here. So if I started with $100 in recurring revenue and I had churn of 10, so it's a slightly different. I said 15% on the previous slide. This is 10%, right? Then I have net ARR of 90 throughout the year. So I have COGS, G&A, and R&D of 50, right? Which gives me recurring profit margin around 40. Mm-hmm. That recurring profit margin, if I spent that, right, to acquire new business, and that $40 of growth expense, which is sales and marketing right there, I acquired 40 new dollars. Mm-hmm. Well, that means I ended at 130. If you think about the math, I started with 100, I lost 10, but I added 40. So the net is 30. I just grew at 30% and I broke even. Mm-hmm. That's a pretty healthy business, right? Not because you broke even, so you'd have some traditional CFOs or traditional investors say, hey, you didn't produce any cash. I'll say, yes, we didn't produce any cash, but we just grew 30%. And the next year, we could decide not to spend anything in growth. Instead of bringing the 40 to the bottom line, right, we now get to bring 70 to the bottom line. Because we just actually, we get to recoup what we just spent from the previous year, and now we have this recurring stream. Mm-hmm. You would have to take the churn into account, but the whole point is, if you build up a recurring revenue base, if you ever see your market start to decline or your growth rate start to decline, you can choose to bring those dollars to the bottom line in free cash flow. And that free cash flow tail should be more than what, the value of that tail should be much higher than what you paid originally to go acquire it.
Right. Tyler, are you looking at unit metrics, for example, sales at a sales level? And
yes, absolutely. Absolutely. So what we just talked about is a very high level business model, right? Yeah. And these concepts are recurring expense, recurring profit margin, growth expense, and then one-time expense. And then within the growth expense is like, okay, how do I measure the efficiency of that expense? Mm-hmm. That's not good enough, right? That's kind of what you educate your entire executive team on and your board on. Say, hey, here's kind of our operating model. Mm-hmm. And you go into a year saying we have goals like a GEI of 1.5 and a recurring profit margin of 40%. These are just high level goals, but they don't actually help you do the real planning when you get down to it. Mm-hmm. What you do, first thing, you're going to walk into that room, you're going to say, we have these goals. And your first thing is going to be, well, why do you think that's a good goal? Right? Why do you think 40% recurring profit margin is a good goal? Why is GEI 1.5 a good goal? And so as a business, you need to understand what those metrics are and what those benchmarks are. So all I can do is I can say, hey, you need to go look at your competitors, you need to go look at the market, and then you need to start doing some research. We do this. We track about 15 different public companies, and we break down all their financials. We also spend a lot of time with the analyst community, the investor community. And we talk to them and say, how do you guys break down these companies to determine what is good and what is bad, what is efficient, what's inefficient. Mm-hmm. And you come down, you get to a bunch of metrics like this, like CAC, like LTV, like ARR, like ARPU. Whereas the old world were things like COGS, R&D, G&A. Those are still important, but now you need to add to them to get to a new world. Here, I'm not going to cover this. This is literally just the calculations of how you get to these things. Mm-hmm. And each layer that you go deeper, you're getting into a little bit more of the unit metrics because that you just asked about, right? Each layer, you're talking about customer life and the average revenue per account and the gross margin. You're thinking about your churn rate and things like that. Even all of these metrics, though, this one's customer acquisition costs. And again, this deck can be made available to everybody, so you don't have to copy this stuff down. All we're doing here is saying, how would you actually calculate these internally, right? And be able to actually measure this internally. Mm-hmm. Net retention, by the way, is one that most software companies in the US at least are now disclosing when they go public. Mm-hmm. And the reason is that the investor community is demanding it. They're wanting to know, hey, if you're not going to bring a lot of profit to the bottom line, mm-hmm. we want to know that the customers that you're acquiring today mm-hmm. are going to be more valuable in the future. And net retention is simply the measure of, does your current customer base, does the upsell that you get against that customer base outweigh the churn that you have in that customer base? And so you take an entering ARR base, an annual recurring revenue base, at the beginning of a period. You take that same exact base at the end of the period. And if it was $100 coming in and you had $10 of churn, but you had $30 of upsell against that base, it's 120 at the end. You have 120% net retention. I lost 10, I added 30. So I essentially, upsold the 90 that was left with 30 in that model. Right now, best in practice is about 120%. What you then need to do is you need to break down the companies that you think are your peer set. And I can tell you 6 years ago when we started this data was not available. I had to walk in to different CFOs, call them up, right, and say, hey, this is what we're trying to do. We need some metrics. It was shocking to me how open everybody was. These were public company CFOs that I didn't really know, that I just started reaching out to. And you realize that everybody has the same challenges. Everybody's trying to run the same model. And many people are doing it blind. You just don't have the data. And so the willingness of folks to share is like, hey, if you share with me, I'll share with you. So that you can come up with these benchmarks and you can come up with comparisons. That willingness was really, really surprising to me. But it's continued now through today, where now we've developed these communities of CFOs and companies that are willing to share this data because they know that everybody needs it. This is just an example of us breaking down recurring profit margin and GEI on ARR for this set of companies so that we can understand when we come into a meeting with our board or our executive team and we put goals out there. We know that the goals that we're putting out there are not just achievable, but they would be best practice or not best practice or middle of the road or whatnot, right? But we know that our peer sets are doing something and we need to hold ourselves accountable to that. So let's just regroup for a second. We talked about a high-level business model. You're in a subscription world. It changes everything for every single function of your business. It changes the way the CEO thinks about the business. So now they got to organize this entire functional groups around thinking about a subscriber. It changes the way that your product head thinks about how he builds product. He's now thinking about how do I innovate constantly and actually learn a lot about what my customers want. It changes the way you grow, right? It changes the way your salespeople go to market. They need to structure great deals that have a lot of lifetime value capacity, but they need to think about serving up experiences to the customer as opposed to shoving products through a channel. It changes the way the CIO works. They need to think about putting in infrastructure that helps you innovate rapidly. And then now it changes the way the CFO's job is now to bring all this data within the organization and then motivate or provide intelligence to all those different functions about how to optimize that business model. The business model is fundamentally different. It's based on a recurring revenue stream, and then you need to think about investments that you make to optimize that recurring revenue stream. Center around a couple of key metrics. Internally, we think about ARR, which is annual recurring revenue. We think about recurring profit margin, which is the delta between our ARR and our recurring expense. Our recurring expense is what we incur to service the existing install base. That's COGS, G&A, and R&D. Once we have our recurring profit margin, we can decide what to spend in growth. And that's growth expense, which is sales, marketing, customer success. We make that decision based on the efficiency of that spend. With every dollar we put into growth, what do we get back for it? And we measure that efficiency by something we call the GEI, which is the Growth Efficiency Index. It's a very simple calculation. And we measure it period over period over period. And then you have one-time expense in your model. Maybe you do, maybe you don't. And the most important thing is to make sure it's very, very predictable. Once you have these metrics or these concepts, you need to assign yourself goals on what to do as a business against those concepts. In order to do that, you need to understand what your benchmarks are. You can start with what you have internally as benchmarks historically, and you can challenge yourself to do better and better as a business. But you should always look at third-party benchmarks as well, and look at what your peer set is doing, or look at what the company you regard as the best, what are they doing? And then challenge yourself as a company to try to get there. Once you have that, you have the constructs of your business model. And you are setting these goals as a business going forward. Once you put that in place, though, you need to have a day-to-day operating concept. And that's an operating framework, right? And that day-to-day is different than your business model. It's how are you measuring yourself day-to-day to make sure you are on track to go hit these metrics that you set for yourself. We have come up with an operating framework called PADRE. PADRE stands for Pipeline, Acquire, Deploy, Run, Expand. And then we add PPM at the bottom, which is Product, People, and Money. I already talked about how every single function, what that function does, can impact the business model in a subscription economy business. There's no concept anymore of a G&A function being in the back corner and they just operate, and really every sales is responsible and services and all these other, and G&A just gets stuff done. Every single function can impact the customer experience. If there's an impact to the customer experience, whether the impact is good or bad, it can have an influence on your business model, because your entire business model is predicated on the fact that you will continually earn your customers dollars through a lifetime relationship. That's the goal. So every single function needs to have a visible kind of upstream and downstream view of what they do and how it impacts that customer lifecycle. To do that, you need to provide information. Every single Sunday, we put out a PADRE report. My financial planning analysis team puts it out Sunday morning or Sunday evening. And on Monday mornings at our executive staff meeting, we review the PADRE report. Sometimes it's a really quick review. It is, hey, is there anything in PADRE this week? Nope, everything looks good. Kind of go through the metrics real quick and we're done. Oftentimes, we use it as an indicator of risk or an indicator of opportunity, and we will do deep dives based on what we see in PADRE on stuff that we need to focus on as an organization. I'm not saying you need to run PADRE. I'm saying you need to have some type of communication method and operating model to be able to inject into your business so that you can give your functions visibility into what's going on into that business.
Tyler, just one clarification on that. Is that a quantitative or a qualitative measure for people, product, and the other one?
I'd say for people, product, and money is very quantitative.
Yeah.
For people and product is more qualitative. Now, it's It is quantitative to the extent that people oftentimes has to do with headcount, right? It has to do with headcount health and headcount growth or termination. And oftentimes that's numbers. So if you think about sales, right? Okay, we are expanding into a territory. We have goal to hire salespeople. It's how are we doing on the hiring? Because the hiring we do today, those people may not get productive for 6 months. And if we're behind on our hiring goals, that means we're going to be potentially behind on our bookings goals, right? And so that's where the people element comes into it. You can also inject a lot of quantitative stuff into people. Again, Padre is not supposed to be a necessary report of, historical data just for data's sake. It's supposed to be an indicator of risk or an indicator of opportunity. So for example, if you do internal surveys on a periodic basis for your employee base, that would show up in the people section. And if those surveys, and you're doing them consistently, say every single quarter, and they're starting to indicate something about certain functions or certain groups that might be at risk, that's the thing where it's like, how do we get ahead of this and how do we start working on it? That's what we would inject into the people section. Product section, to be honest, for us, it doesn't change that much. It is a way for us to get visibility into kind of the roadmap. The roadmap is constantly iterating, right? And remember, you have to be driving constant innovation. It's really also how's that roadmap being influenced, right? So we influence our roadmap through what we hear from our customers. We also influence it by what we get from like support and tickets and everything else. And we influence it by what our product people in turn have in terms of vision for what we want to build in the future. Right, so all these data injections can come in and actually influence our roadmap. In Padre, it's very similar to your business model. You have all of these different metrics that you can measure and you can produce. And I would highly advise you don't just produce data for the sake of data. I mean, data, you could get so much and you just get lost in it. You don't know what to do. But pick some certain things that you want to measure, and you want to measure them consistently over time. And then again, you need to start thinking about, okay, is it good or is it bad? The first thing to measure against is your own historical performance. The second thing to measure against is what are the benchmarks that are out there. We as a company said we need these benchmarks. So 3 years ago, I started putting out a survey. And it's hard to get people to take surveys. But I put it out to CFOs. And I said, hey, CFOs, we all have the same problem. This year, we got 400 companies to take our survey. The survey was not like high-level metrics. The survey was a very detailed 70-question survey about very invasive data. What is your pipeline coverage? What is your sales ramp? Right? What is your quota attainment? These kind of questions that everybody needs in terms of their modeling, but nobody has. Our survey, the difference was that if you take the survey, you get all of the data. We send you a CSV file with all of the raw data, because it wasn't about producing a survey. It was about everybody getting data that I need myself to do my job. So we think about pipeline. I'm going to fly through these really quickly because, again, we will post this presentation. But to remind you, Padre is about giving you a full view of the customer experience as a result, as it is presented from a functional level within your company, and allowing every function. So say deploy. They need to know, this is our global services organization. They are responsible for bringing our customers live. They need to know what's coming down the pipe from the acquisition. If we're closing these deals, they need to plan for it. Run is really our tech ops and our support. They need to know which customers are going live so that they can make sure that they are ready to bring them on. If we have a customer that's going to have 1 million subscribers on it, on our platform, our tech ops people need to know that. They need to be ready for it. And so this is the whole point of the Padre. And in doing so, you also then come up with these metrics. Are we doing well? Are we not doing well? What kind of coverage ratio should we have against quota, right? How many SDRs, we call them ZBRs internally because we put a Z on everything, like sales development reps, how many should we have, right? How many leads do you need? On the acquire side, when we actually model out our business model, right? What is our underassigned back to market based on the quota that we have out on the street? How do we model our sales ramp? And how does that compare to what other companies are doing? How do we model that quota attainment, which is actually different than the underassigned because you're now doing it at the rep level, right? How do you model sales cycle, right? As you expand, do you expect the sales cycle to get longer, or do you expect it to get shorter? You expect it to get longer if you've actually picked off all the easy deals, and you actually have to have more of an evangelical sell. You expect it to get easier if you've actually done a really good job at educating your salespeople, and that you're better at selling now. Both are really, really hard, right? What do you pay in terms of commissions? That's really important, right? I've done these webinars before. We will spend an hour just talking about sales compensation. Everybody wants to know about sales compensation. On the deploy side, right? Do you charge for your deployment? Do you break even? Do you lose money? Right? What is the average fee? Do you include it on your service or your subscription, or do you actually charge on top of it? Well, how long does it take a company to go live? Obviously, it's no surprise that there's a correlation. For the longer it takes to go live, the more that people will charge for it, right? The more you have a self-service product, more oftentimes it's thrown in, right? On run, what do you think about in terms of subscription gross margin? I can tell you right now, if you're a SaaS business and you're running at an 80% gross margin for subscription, you're doing really well. What if you're running at 75%? How do you actually take that 75% and actually create a business model that can get you to 80% going forward? That's a tough thing to do. How do you think about what do you spend on an engineering resource, right? And how do you then think about different locations and offshore development? Are your customers committed, right? What are your contract terms? Are you signing them up for monthly, semi-annual, annual, or more? On an expand side, which is really one of the things that I already mentioned, people key in on, right? Who manages your upsells? Right? Is it a customer success group or is it a sales group? It's an important question because this is where you get leverage in the model. If you're letting your salespeople do your upsells, and you're probably paying them the same amount for an upsell that you are for a new deal. When do you move to a true hunter-farmer model where you have people who are responsible for new logos and people who are responsible for upsell? On the expand side, what is upsell as a percentage of total bookings? An upsell should be easier than a new deal. A new deal you do not have to create pipe for, right? You don't have to go out and actually acquire that customer. On an upsell, you don't have to create pipe. The new deal, you have to be evangelical, you have to go compete with competitors, right? You need to get somebody through a procurement process. The upsell should be a very, very quick process. How do you optimize for it? These are all questions that we have, on a day-to-day basis as we run our businesses. These questions on a day-to-day basis, how do you back in and create an operating framework that you can put structure around? And as a CFO or the COO or whoever you are in your company, take charge and actually make it your responsibility to inject this data into your organization and into a cadence, an operating cadence within your organization, so that you're providing this data in a consistent fashion every single week so that you can actually make decisions off of it. Not just you as a CFO or COO make decisions, but that you can enable the functions who are responsible to make decisions, but very, very informed decisions. In order to do that, right, they need to know how these decisions, what the ramifications of those decisions are. That's why it's important not just to think about sales or not just to think about your run. You need to think about it all holistically and think about what the ramifications are of what one group does versus the downstream ramification, what that's going to mean for another group. And constantly present this as one common view for your management team so that they can make decisions together as opposed to in isolation. That's the content that I had today. And then Vikas, I think we have some questions that we can move to, but hopefully you found that informative. I know there's a lot of detail there. I flew through a bunch of the slides. Again, we're going to post those slides. The intent wasn't to cover all of the different metrics. The intent was to introduce the concepts of a business model, the concepts of an operating model, and make sure that as CFO or COO or somebody who's in charge of really injecting that information, that you're doing it on a consistent basis and that you choose something that works for your business.
Tyler, thank you very much. That has been very informative. So there are a bunch of questions, and I wanted to take a minute before I jump into that. So guys, you have sent us your questions up front, and we thank you for that, first of all. We were hoping to go a mile deep with Tyler because we had his time, but you surprised us by the broadness of the interest and the questions that you've sent us. So Tyler retuned the presentation to suit the interests of the broader audience. And he's covered a fair amount of ground. What we are going to do now is I'm going to ask the questions on your behalf. We are not set up to do live Q&A. I hope you understand that. And I can't see some of the questions that you're posting on my screen at all. So Tapas is monitoring that, or Ronnie is monitoring that, and hopefully we'll try and get those answers to you. So let's start with some of the questions that you've asked. And we've bucketed them and we've shared them with Tyler. Let's start with the generic questions. Tyler, you see a lot of businesses, and what we are trying, or what alumni are trying to wonder is a peaceful coexistence between legacy businesses and the new subscription business possible, at all possible? How do companies, traditional companies, launch subscription businesses and cannibalize their existing revenue streams? What's the impact, and how do they go about it?
Yeah, and I think that's one of the things that we see from our customer base is one of the biggest questions out there. And the goal that a lot of our customers have isn't to say, how do I coexist with my old business? When they actually engage with us, they've come to the realization that their old business may not be sustainable, that they actually can't just keep going down the path that they've been going down because the world is changing around them. So we have a lot of auto manufacturers that are customers of ours. Mm-hmm. And they realize that the future of consumption as an individual is to not necessarily go buy a new car. If you think about it logically, cars are being built to last a lot longer, right? Cars have a lot more technology in them. And the future of cars are self-driving, they are electric, they are, they have all this innovation. Mm-hmm. And cars are essentially becoming, if you look at the Teslas of the world, they're becoming computers, right? They can be updated and whatnot. So these car companies aren't thinking about, how do I create a new subscription business while also just creating my old legacy business? If they think that way, they're going to be left behind. What they're thinking about is, how do I look forward and realize that there's going to be a collision, that there is no such thing as my legacy business, and a separate subscription business. They have to be brought together. Mm-hmm. And so they're working now with us, right, to think about, what does it mean 5 years from now? How do I start to think about changing from a product business where I manufacture a car and I push it to a dealer? I really never even know who my end user is. And the only information I have is when they bring that car in for service, I might get some information back from the dealer. They now think about it as like, how do I think about a subscriber who I actually don't care what car they buy. All I want to know is that they might get into my brand of car. And when they get into my brand of car, they can plug in their credentials, and up comes their mapping software. Up comes their music service that they subscribe to. Up comes the Wi-Fi that they have that's being enabled through the car. Maybe even up comes the insurance that they have, because I know everything about how they drive because they are always getting into our brand of car. Mm-hmm. In that world, it's not about, I produce cars, and then I have a relationship. It's fully integrated. It's the same thing for any traditional product-based business. That's now thinking about, how do I think about a longer-term relationship with the end user who's buying my service? Mm-hmm. And at the end, it always comes down to data. What kind of data can I glean by putting a sensor in that doesn't cost hardly anything anymore into these devices? Right, and start to glean and push services, or start to learn and actually innovate faster. Mm-hmm. And so yes, you can coexist today, but if you're not making changes now, not just in the way you think about your business, but also from the way you design your products, so that in the future you can actually execute on one of these business models, you will be left behind. We have customers who started to see this, and so they started to throw sensors into their equipment and into their machinery 5 years ago, not, having no idea what they were going to do with the data, but just knowing that if they didn't have the capacity to collect the data, and they didn't have the capacity to learn about usage, that they will be left behind. Now they have data sets and they're saying, how do we create business models around relationships with end customers so that we can actually utilize that data set that we invested in a couple of years ago? And we have customers who are kind of behind the ball and they're starting right now. So we have both.
Okay. And when people start or companies start thinking about this transition, what kind of teams are they setting up, generally speaking? What kind of profiles are they looking at?
I think what you'll find, the traditional teams exist and they stay the same. But they has to be injected with a change of thought process. And I kind of went through the functional changes that we see happening. Then you will actually see some new functions start to be created. The first one often is a chief digital officer, right? And you'll say, okay, who in the company, specifically if it's going to have some type of digital experience to your business, maybe it's a media company, right? Maybe it's an over-the-top services business, right? Maybe it's an IoT business that's going to have some type of digital ramification. That digital officer has to start thinking about, how do I interact with the product organization, with the sales organization, with whatever channels we might have externally, to start making sure we have the right relationships with our customers. The second function that starts to evolve is something called customer success. Whereas previously it was just really support, which is reactionary. A customer has a problem, they call into support, they give a ticket, right? You solve that problem. Customer success is really thinking about, how do I motivate a customer to use my product more? It's not reactionary, it's proactive. Knowing that if I get engagement with a customer and I actually elevate the experience that that customer has with my product or service, I will have the right to keep that relationship. And if I have the right to keep it, I'll probably have the right to monetize it to a higher degree. That's what customer success is challenged with, right? They want to eliminate churn on one side. They want to keep customers, but ultimately a mature customer success organization actually promotes usage of your product and adoption of your service. And in doing so, gets a stickier customer base.
Right. So stickiness is equated with better experience. That's what you're really saying. And to what extent, if a client is spending $1 with you today, have you seen the upsell opportunity? And is that really monetizable?
Yeah, I would say the best in class companies in our peer set, right? They have 120% plus net retention. That means that install base that they enter a year with, they know that they're going to get 20% growth off of that install base alone. Right. That's a leveraged business model right there. It's not like a support stream that just stays the same and your goal is to keep it the same. It's the opposite. It's a support stream that grows by 20% a year. That's amazing, right? That is why businesses are in love with these business models. They know that if they execute a subscription business model correctly, it has a ton of leverage in it. Right? And that's why the investor community is valuing these businesses not on, free cash flow multiples or PE multiples. At the early days, they're investing in them on revenue multiples, which is kind of unheard of, right? In traditional economic times. But the reality is, if executed well, and if you have a sticky product that a customer actually perceives value with, right, you'll be able to monetize that customer to a higher degree going forward.
So if we take the argument a little bit ahead, what you're saying is subscription businesses should be really valued differently by an investor, as opposed to non-subscription businesses, which are really bringing in the money today and keeping the lights on.
Yeah, it's not my argument. It is the reality. If you go out and look at the market and you look at, just look at public company comps, how are these businesses being valued? You have a lot of companies that are, from an operating income perspective, are losing money, right? Either GAAP or IFRS. And even on a non-GAAP basis, where you typically take out stock comp and other intangibles. But they could be producing cash, right? Which is an anomaly in a subscription business, right? But because they're growing fast, and the investor understands that, hey, they could throttle growth whenever they want to, and they could bring cash to the bottom line. And that cash is going to have a very long tail because it's a recurring revenue business, that we should value them a little bit differently. And they're actually more valuable than a traditional product-based business. A product-based business, you have to enter the year and you have to repeat exactly what you did from an execution perspective the prior year. And you have to do it to a higher degree to grow. And your only leverage is to sell more product or spend less in selling the same amount of product. In a recurring revenue business, you enter the year with a book of business in the bank, and you're going to earn revenue off of it. That's a pretty powerful business.
Understood. So let's suppose that I'm a business. So let's suppose that we want to start as initial subscription business. How do you actually price that? Price a model like that?
Yep. And that's a challenge, right? So what we would advocate for our customer base, and it's the reason they actually buy our product, is that you actually will have to iterate on pricing and packaging constantly. Right? You need to figure out, it's not up to you as a business on how do I go price my product, right? You have to decide how to enter a market, right? And you would traditionally look at it, and you look at your gross margin, and you would say, okay, how much does it cost me to sell? But the reality is, if you're doing it the right way, your customers will determine what the value is. And you need to be able to be flexible enough to iterate fast enough to be able to maximize that value through elasticity testing, right? You need to constantly check. We have a customer who's a public company now, right? It's been a customer now for about 9 years. Their first year on our platform, they changed their pricing up to 20 times. Can you imagine that? Changing your pricing 20 times just as they iterated on what was working and what was not working. We change pricing almost every single year because we're constantly thinking about what is our customers, what are the perceived value that they have, and how do we actually then make sure that we are pricing and packaging in a way that our customers are going to be aligned with us in that value. Of course, if you're entering the market, you can't just do that. So you got to start somewhere. You start with what your competitors are charging, right? You start with what maybe if you had a physical software product, what were you selling it for? The old school would say, hey, take a third of that. And that's your annual, that's your annual cost. If I was selling it for $120, right? Then maybe it's $40 per year, right? That's kind of like that was the old school entrance. I would say now it has to change. And the way it changes, because your pricing and packaging has to be relatively fluid. You might want to have a whole bunch of different kinds of models. You want to have usage models, right? You might want to have annual recurring fees in addition to usage. You might want to have the capacity to do a lot of add-ons with additional products and services. And so all of those things are not just static pricing. It's all about constantly changing and thinking about iteration on that pricing.
Right. For a large company, this is going to be a big challenge, isn't it? Changing price 20 times is just out of, it's difficult to imagine. Even changing price book 3 times a year and what impact there is on the existing systems and what needs to change, that must be very difficult to put in place.
I was a controller at a Fortune 500 company or a Fortune 1000 company. If we wanted to change price, it was a 6-month process,
right,
to get it through the Oracle and Siebel systems. And you had to know exactly what that price was going to be. Because once you started the process, you couldn't change it. It would be another 6 months, right? Those days are over, right? You have to have a system that allows you to iterate. Now, even then, for a big company, this is still really hard to digest. And so I would suggest, first of all, you have to have a bought-in strategy because these are also expensive, right? Any new product or service is expensive to go invest in. And a subscription-based model is not going to pay off right away. It is an investment. If you're traditionally selling a product for perpetual software and you're living and dying by the $20 million deal, and all of a sudden you start offering your product for $150 per user per month, it doesn't work. I ran finance for the Siebel on-demand unit, and we tried to do exactly that. Right? We tried to inject a SaaS business to compete with Salesforce at the time when Siebel was living and dying by these big deals. It did not work, right? Unless the whole company is bought around it, unless you design all of your comp, all of your measurement, and the expectations are set the right way.
Got it.
For the companies that come to us, these large organizations, first of all, it has to be a bought-in strategy from the very top. Second, it often works best if you kind of carve out a business unit and allow that business unit to go experiment separately, right? And allow them to go execute on offering these new products and services.
Right. So let me try and finish with the pricing questions. How does the pricing change work for intangible industries like healthcare? Do you have any examples?
The healthcare examples that we have is more around experience. So there's a couple of different, so there's life science examples, and these are being driven by technology. So think about MRI machines, who traditionally you go, at least here in the States, you go into this clinic or a hospital to get an MRI, right? And for a clinic to get an MRI, they have to spend a couple of $1 million to be able to purchase that MRI, and then they are able to, actually come back and earn the right to, hold on a second here, earn the right for that customer to have your MRI done. But that clinic had to have a ton of upfront cost. Mm-hmm. The reason there's so much upfront cost is because the compute power in that MRI machine was so expensive. Through technology, there's now companies who've been able to take that compute power out and put it up in the cloud. And so the MRI machine is more of a camera, but then they pull all the data up and put it up in the cloud. What's allowed them to do, which is the manufacturers of the MRI machines, to go sell their machines to all these different clinics. Instead of asking them to pay a couple of $1 million, they say, hey, pay $100,000, but then we are going to charge you on a per scan basis, right? And on a per scan, because we're doing all the compute power in the cloud, right? That allows that clinic to not have as much upfront CapEx. They know their exact costs on a per scan basis to what they're being charged by the manufacturer, and then they can pass on that cost to the patient with a very predictable margin. That's an example in healthcare, in life sciences. In healthcare, what we're seeing specifically in the U.S. is these doctor these kind of practices being developed that are saying, hey, for individuals who might want a relationship with a set of doctors in a practice, but they don't want to have to be part of a big group and under a healthcare plan, pay us a subscription fee. Pay us $50 a month, and that will give you access to a set of doctors and a whole different set of offices, and that's your underlying fee. We'll have to charge you more for other services, but by being a member of our practice, right, through paying that subscription, you get this premium access. And there's a whole bunch of these companies that are starting up in the U.S. as a result. We see this also in financial services, very, very similar, right? Where it's all about, hey, let's create a relationship with a patient or with a customer. And that customer is willing to pay us some fee to have that relationship. And in doing so, though, we actually, they don't have to feel like they're getting nickeled and dimed every time they walk in the door, because they've already established this relationship, they've already earned it. So we're seeing this change happen in every single industry.
Understood. So if I were to take a traditional B2B company, and you must be seeing many of those, what are the ones that have failed really? Do you have any examples of why they failed?
We do have companies who have failed, right? And I'd say they failed in their initial attempts. Oftentimes, it's a company it's not really, it is not core to their strategy. They put their toe in the water and they say, okay, we think this is probably something we need to do, but then they don't actually go all in on it. We had a company as a public company. They became a customer. They came out with a whole strategy around offering a service, and they were shifting from kind of a traditional product sale to kind of a services business. Mm-hmm. Well, they came out and announced to the public that they missed their earnings. They laid off 30% of their workforce as a result, right? And in doing so, they scrapped all strategic initiatives. It is hard for a company to invest and make the decisions to go change their entire business model. And unless you go all in on it, you're probably not going to go follow through with it when times get tough. The unfortunate thing is the companies that don't follow through in it, they never see the light at the end of the tunnel. In fact, they continue to miss earnings, right? Because they are missing earnings because they're already being left behind and they're late to this shift. So if companies don't, really go into this with a very concise thought around what the business model is going to be, what the strategy is going to be, what the investment is going to be, and they communicate that out to their investors and to the market and everything else, and they go full into it. If they don't do that, they might fail.
Understood. So in a market of low barriers to entry, what's the way besides experience? And we got that point. Against new entrants who are operating at a loss to gain market share?
You have to know your customer. I mean, if you're going into a business that has low barriers of entry with high competitive dynamics, I mean, the first question is, should you be in that market, right? But if you do come to the conclusion that you should be in that market, you've probably come to the conclusion that, your product is a better fit for your customer base. And that's why you're saying I can compete. Mm-hmm. In doing so, you need to make sure you figure out how to have that customer perceive that value of your product and build from there. Now, the risk is that you try to go in and acquire and you're competing with these other companies that are trying to acquire as well. Mm-hmm. We've had customers, we've had competitors come in and you can, go tell a customer and you can lie to them and you can tell them that your product is better and you can acquire that customer maybe through that process. Mm-hmm. The beauty of the subscription economy is that you have to continuously earn your customer's relationship. And if you are true to what you do and you truly, run this model and you believe that your product is the best because you're constantly innovating on it, and you're constantly trying to do right by the customer, both in the way you contract with that customer, but also in the products that you serve up to them, then you will succeed in the long run. It's so important that you have a business model that's going to allow you to be around for the long run. That you are not, executing against a business model that's throwing all your capital down the drain just in hopes of succeeding in your first year. You have to have a long-term view of these businesses. It is a marathon, not a sprint.
Got it. So Tyler, there's a question on the Q&A. I can't see it. For some reason, my Q&A is disconnected. Tapas has picked it up. And the question is Padre meant to replace the older concept of the balanced scorecard?
Yeah, maybe. Again, Padre is what we use. I think it works. I know probably hundreds of companies that have now taken it over and they report on it internally. My only recommendation is figure out what works for you internally and be very, very consistent in your application of that. And then you also have to iterate. By the way, we iterate on Padre. The same way you iterate on pricing and packaging, the same way you iterate on your business model, we iterate on Padre. There could be a new metric that we will go deep dive on. It fits within the Padre concept. It fits within one of those functions, but that doesn't mean the information is always exactly the same. We have specific information that always stays the same, but we add to it or we take stuff away if we feel that we don't need to measure it anymore. Okay. The balanced scorecard, we actually take Padre and then we put a sheet at the very beginning of Padre. Mm-hmm. And that is kind of the red, yellow, green, right? What is red, what's yellow, what's green across all of the Padre elements. And that's what tells us whether we need to go deep dive into a certain area of Padre. And sometimes that's the only sheet we look at. Because if everything is, green or yellow and it seems to be okay and it's not really moving week to week, maybe we don't need to spend a ton of time on it that week. That's kind of what I think your balanced scorecard is. It's kind of the same equivalent of that.
So Tyler, do we have time for last 4 questions?
Yeah, let's do it.
Wonderful. So assuming that capital efficiency is being closely monitored by companies and investors alike, public and private, are you starting to see metrics for time required to reach a desired threshold of, say, ARR and churn? How does churn come into the picture? What are
churn is, and every investor would want to know what your churn is. And in the public domain, you don't really share what your churn numbers are. Very, very few companies do. What a lot of companies do is share their net retention. Yeah. And again, an investor is looking at net retention as leverage in your business model. And if your net retention is high, they know you have high leverage. If you have high leverage, you have the capacity to produce cash. It's as simple as that. Because you can pull back on growth expense and you can produce cash because you're going to be able to monetize your existing install base year over year to a higher degree. Investors are demanding, right, that there is a visibility into leveraging your business model so that you can produce free cash. They're paying less attention to GAAP or IFRS metrics, income, but they're paying more attention to free cash flow, which I think makes sense. All the numbers are really important still, but yes, if you get to some certain level, the investors are going to think, why aren't you producing cash yet? And the only excuse for not producing cash is that you're using all of your cash to acquire new customers and you're doing it in a really efficient manner. If the investor sees you, doing that, but you're becoming less efficient at acquiring customers, meaning that you're spending more to grow, then they're going to punish you.
Okay.
Because I have time for one more question.
Okay. So let me ask you a question about Zuora then.
Yes.
How do you compete with giants like Wirecard and WorldPlay? Are they a competitors at all? And how do you see consolidation in the industry moving forward?
Okay, so WorldPay is actually a partner, not a competitor. So we are not a payments company, right? We are a subscription management business. If you think about our platform, we are your system of record for your customer base, your product catalog, and we also do all of your billing. As part of doing your billing, we partner with a whole bunch of different payment companies, right? Because we have pre-built integrations to all of these companies like WorldPay. So WorldPay is a big partner of ours, not a competitor. We would go in and you would use our platform to manage your entire quote to cash cycle for your customer base. But if you wanted to use WorldPay as your processor, right, we have already integrated to WorldPay. So we would send the instructions out of our system to WorldPay to actually collect the money. We then pull back that information and we are your system of record as did they pay, did they not pay, how much did you collect, did you apply that payment to a certain invoice, things like that. When we look at our competitive dynamics, our traditional competitors are Oracle and SAP. Right. And the reason that they're competitors is historically companies have run their businesses on these legacy ERP systems. Mm-hmm. These ERP systems are built for product economy businesses, right? They are built for the businesses of the past. At the core of their architectures, these systems think about a SKU, and they think about a buildup of that SKU, which is a bill of materials, and then they add a cost to that bill of materials, and then they think about the revenue that they get from that SKU, and they think about widgets. Mm-hmm. We have designed a system that completely inverses that. We think about a customer at the middle, and we have a concept of time, right? And then we have a whole bunch of transaction sets that are very, very complex that you can execute on our system. If you think about where we sit, we would sit in between your CRM system, and we'd sit in between that and your GL, which is essentially your traditional ERP. And that is where Zuora sits as a product.
Right. Okay, wonderful. We haven't really covered revenue recognition, but I hope that you'll
next time.
Next time.
Next
Tyler,
time.
Thank you very much. It was wonderful having you. It was very informative. And I wish you a good day. Thanks a lot.
Because thank you to you and INSEAD for putting this together. We really appreciate it. Thank you very much, everybody, for participating.
Bye-bye.